on to
Welcome to
I
lunch
thought
and
my
learn. You're already
compliments and use
enjoying
you, and then they're
lunch
still
that's been
on the
provided
fence.
by Comparing Insurance Agency. We have Chad Williams, England Walker. So they're gonna turn it over to them. They're gonna share some information about their company and what they can provide services for your clients or yourself.
Thank you.
All right, good morning, everybody. Hope everybody's enjoying their lunch. Thanks for having us in here today. It's always nice to come in here. I know it was just in yesterday for committees, so I think it's the first time I've ever been in here 2 days in a row, which is kind of neat. But yeah, we're with Comparing Insurance Agency. Our office is actually based out of Frederick, Maryland, but both of us live here in Martinsburg, and we really only work in the office maybe 1 to 2 days a week. So we're pretty well local and always here in Martinsburg. So as far as kind of what we do with Comparion, we are owned by Liberty Mutual, so we have the backing of a Fortune 100 parent company, but we're an independent insurance agency. So what that gives us is we have access to give or take around 20 to 25 different carriers, depending on which state. Licensed as far south as North Carolina up to Pennsylvania, so can pretty much work with anybody you're going to come across in this area. And with that, with that access to multiple carriers, we can kind of be a one-stop shop. And if somebody is, first-time home buyers are kind of my specialty. That's what I enjoy working with the most. And as somebody is buying a home for the first time, we are able to answer any insurance questions that they have, and take a really good, look into the process for them. A lot of the time they don't understand. If you go online or somewhere like that and just get a basic home insurance policy, there's a lot of things that a basic home insurance policy really isn't going to cover for them, and they're not going to know that until the worst time hits. And the worst thing in the world is to have like a water line break in your house and find out that it's not covered because you didn't add water backup coverage because you were just looking for the cheapest insurance policy you could find. And those are the kind of questions that we can kind of guide people through that process and, maybe help them with their home, auto, their life insurance. We can do it all for them. In addition to that, answering all their questions, we also then have that ability after all the questions are answered and we've decided what coverages are needed, that we'll take that back and be the one-stop shop. And we will be able to run that through every company that we work with. We've already decided what coverages you need, what's going to be the best fit for you. Now we're going to find what company is going to give you the best price to get those coverages, and then at that point come back. And kind of as far as the value that we provide to to realtors or mortgage lenders in specific that we work with is one of the biggest things, it's a real hassle to end up losing a sale because you found out that your client can't hit the debt to income ratio, and right before closing, or you get to 2 or 3 days before closing, and they don't have that. Our turnaround time to get a policy done for them can be about an hour, and most of the time, whenever somebody gives us a number, which I know it's beyond the realtor at that point, but you're still wanting the sale to go through. When somebody gives us a number like, hey, we need this number to hit the debt to income ratio or the loan won't go through, because we have so many different options and different carriers, we are usually able to work that to make sure that things get through for them in that regard. And then, another thing with realtors in specific is you're moving into a home and maybe you're wondering, like, has this home had water damage? Maybe you see a spot that, that doesn't look right. It looks like something's happened. We do have access to those insurance history reports as well, where we can look back and see, hey, they filed a water damage claim 2 years ago. That's what that spot you're seeing in the basement is, or that's what that spot you're seeing on the roof is. And we're always happy to do that, for anybody that we work with. So, I think as far as the value that we would provide to you is, your clients don't have to call around a million different places to look for insurance quotes. They've got one place, and maybe they haven't decided on if this is the house they want yet, or maybe they're down to 2 houses and they're trying to figure out and they really can't figure one out. And then we can run those numbers preliminary for them. They don't have to be in the pending stage. We can run those numbers and say, hey, if you buy house A, your homeowner's insurance is gonna be, $80 a month. If you buy house B, your homeowner's insurance is gonna be $150 a month. And give you an idea, before they get to that stage to make an offer of just what all of their cost entails. So, having that for them, being able to take care of the debt to income ratio for them, and being able to see those claims history, I think is the biggest service that we provide, as far as with you all, and just also that ability to kind of run every product for them. Home insurance, auto insurance. Most first-time home buyers also need life insurance. We have a ton of options when it comes to that. So able to really help with the full spectrum there. Glenn, I know you wanted to talk a little bit about life insurance, I think. So.
Yeah, I'm Glenn. I've met some of you. I know that I haven't met everybody, but I'm local to Martinsburg, and I went in the insurance industry over a year ago, so I'm still pretty brand new to it. But I'm very compassionate. If anybody's ever met me or had a customer with me, persistency is key in this industry right now, because countrywide, I think we're all very lucky to be working here in this area and to be licensed in Maryland, Virginia, West Virginia, because if we were in some of those southern states or California, we would be in a major struggle, even in real estate. And I think I think we're all very lucky to be here. I know that just like he said, from some of the lenders that I work with, they know that I can have a turnaround policy within an hour, get them what they need. And even offer that life and mortgage protection, because you're buying a $500,000 house. We're probably the only carrier in the country right now that offers a term policy for 30 years. It's less than the coffee that we pick up at Starbucks every day. And for somebody to get that added mortgage protection, that is a huge benefit, because I have actually seen real life what it's like for somebody not to have the protection, and after having a home, and then losing the house from somebody that has passed away. And I'm not here to be a Debbie Downer, but the last thing I want to do is see a customer go through that after they bought a beautiful home. Something happens, because life happens every day. So we want to make sure that we are providing the best all-around service for that customer. So that's I've been very successful in life insurance in my first year. I'm going to keep pushing this, for mortgage protection. And, we have a line of, term and whole life policies where, the investment option is there. And, I'm PNC right now, for me, is probably dwindling. It's been a pretty big struggle, and I'm going to keep pushing. And I tell my customers, my biggest thing is consistency. If I couldn't find you an option the month before, I'm going to find you an option and keep following up with you in 30 to 6 months, and they're going to keep hearing from me. I'm not trying to annoy them, but keeping that option and that phone call and that line open to them, because I've had customers here recently that have been dropped by their insurance carrier, and they had no idea, and we try to find them that option. And when you have a lapse in coverage, I think they're going to remember, and that's the honorability piece with our company, because we always have somebody that we can get you insured with. And the referral business for realtors is what we're all about, and that's why we're here today, because we want to introduce ourselves and show you what we have, and work with you in the future. Thanks.
Well, thank you all for having us, and please, help yourself to as much food as you like. I've got a stack of cards. Obviously, leave the cards here. If you want to grab one, reach out. My cell phone, my email, my home phone. Or if you want to just pass those around. Pass Glenn's around too. But yeah, my cell phone is on there. That's my personal cell. Also, of course, my work phone, my email. I'd love if you just reach out, shoot me your contact information, and if if there's ever a client that I can help with, or that Glenn can help with, please feel free to reach out. More than happy to do anything we can.
Thank you.
Thank you all for having us.
Thank you guys so
Yeah,
much.
thanks.
It's a wonderful lunch. So I forgot to introduce myself when I came up. Many of you guys know me, but I'm Angela Horner. I'm the chair of the Education Committee and vice president of EPBR. I'm happy to present Christina, and I'm going to let her say her last name because I won't remember it. Ocharzak from First Home Mortgage, who's going to present to us behind the scenes of the loan process. So I'll turn it over to you.
Thank you, ladies.
Hey guys, how are we?
Good, how are you, girl?
I'm good. So, alright, just a little like roll call so I can get a little feel for like how long we've been in the business. 6 months or under. Okay, alright, good. A year. Alright. 1 to 5. Alright, anybody like a wife longer here?
Yeah, get
All right, who's the longest? What do we got?
37.
37. Is this the winner?
She told me she was 12.
So, how many of you are like really, really familiar with the whole process? Yeah. Okay. All right. Well, hopefully you guys can pick up something still today from this. So. I've changed it a little bit, like from when I used to do this and rates weren't a thing and stuff like that. So I'm going to kind of talk about points today, like how those work and why they're important, stuff like that, to try to help you, encourage your borrowers that like rates really, yeah, they're not where they were, but they're not as bad as they could be. So, all right. So to start off, you guys know this, right? Pre-approval versus pre-qualification. This is like elementary, right? Like. I can promise you if I was a seller, I would never, ever, I would tell my agent, if they're not pre-approved, I don't want them in my house. Like, it is a waste of time. So, people call me all the time, and like, I just want to know, like, generally, like, it's garbage, really. Like, you can't truly tell somebody, like, well, what about just an estimate? No, I can't do it. Like, I'm not going to give you a number that is just not even realistic. So, let's focus on the pre-approval. All right, so that's when you provided us all of your documents. We've run it through automated approval systems. Automated approval systems, which we're going to talk about a little bit more in depth in a few minutes, have changed a lot. Like there are files that you think are going to be golden, and you run it through, and it's like, no, refer with caution. And you're like, what? Why? Like it doesn't make any sense. So they've tightened down a lot of things. I actually just had a lender call me the other day, and she's like, I don't know what to do. She's like, she's not in our company, like different company. I'm just friends with her, and she's like, I thought this was like easy. Like I don't know what to do. Like I didn't run it, and now we're into underwriting, and they ran it, and it didn't go. So it's happening a lot right now, and lenders, unfortunately, as we know, the market's a little rough, and people are just taking deals. And they're like hoping they can get them to work instead of doing all of this due diligence. Because we get a lot of pushback, people don't want to provide things and all of that, but it's just really important to educate the consumer as to why it's important that they do this, and how it could potentially save them money, and instead of getting halfway down the pike and we've lost appraisal fees and home inspection money and now the loan doesn't close and everybody's mad. So, the first thing I try to do is, try to get them on the phone for at least 15 minutes. Go over which direction I'm headed in. So, what are their goals? What price range or payment are they looking to stay in? All right, this more than often doesn't align where they want to be payment-wise and then what they're looking for house price-wise. So then I know, I write those things down, and then when I call them back and say, hey, yeah, you can do $350, but that's not what payment range, you wanted to be at. This is more of what's comfortable for you. So what area of state they're looking at, which is going to determine some of the products I might use. Are they planning to put any money down? Are they looking for 100% assistance programs? That's going to determine what kind of documents I'm going to need from them. Are they a veteran? Are we going to be looking at an MBA? If they've ever owned a home, this question doesn't get asked a lot, and then we find out they've had a foreclosure or something like that, or they're still entitled to a property with an X, all kinds of problems. So, and then I always ask if there's going to be anybody else residing in the home, if I'm looking at any kind of USDA or anything like that for eligibility income. Credit report, this is the next thing. Once we get past all of that, the next thing we're going to do is pull credit report. People love to use Credit Karma. Unfortunately, the scores, they're not wrong. They're just different than what mortgage lenders use. They just use a different score model. I tell everybody it's a great thing to monitor your credit, and see what's on there. But as far as scores go, I've had people tell me their score was a 500 and I pull it and it's 7 and vice versa. It's not statistically like higher or lower, it's just different. So on the right, you'll see like how an actual score is made up. Obviously everybody's like, oh, I pay my bills on time. Okay, great, that's only 35% of what makes up your score. The other huge part is the amounts owed, 30%. So when you have a borrower that has, say, a $300 credit card and a $299 balance, the computer system looks at it and goes, whoa, they're maxed. If you take that same $299 on a $1,000 limit, they're at 30%. So it looks and says, oh, okay, they're not overextending themselves. So it drastically changes that score, which is the number one way that I can rescore people and try to get them to bump their credit scores. It's just simply by paying down debt. Unfortunately, if the payment history, if they're late, all you can do there is give it time. That's the only way to fix that, but we fix a lot on amounts owed. You'll see new credits 10%, types of credits 10%, and then your credit history. A lot of people will, a department store goes out and they'll close their credit card. I tell people, do not close your cards. That diminishes your longevity. Leave them open, cut the card up, get rid of it, but let that on there because that's gonna help the longevity report. And then, over time, that creditor may close it at some point without usage, but by then you'll have established more down the road. So how does that score affect the loan? Obviously, rates, programs. Right now, interest rates are not pretty for lower scores. So if it's not at the lender's minimum, then we look at doing options of a rescore, which is what I was telling you about the amounts owed. So say that, same $299 borrower with the $300 limit, I can get them, I'm like, hey, you gotta pay it down to $10. And then I get a letter from that creditor showing the new balance is $10. I submit it, we pay for it, it's no charge to the borrower. It's a little bit pricey, so I wanna feel confident about my client, but we submit it and I can have a new credit report in 3 to 5 days with a new score, instead of waiting for it to report and then try to catch it and make sure that it's there. So that's an awesome thing for us to look at. So this one I get a lot, about pooling credit reports. We do have the availability to do a soft pool. I'm not a huge fan of it, really, because, if somebody just really, really gives me a hard time and they want me to do it, I'll do it. But ultimately, we're gonna need a hard pool. If you want me to run it through automated underwriting, I have to do a hard pool to get through LP. If I'm doing DU, which we'll talk about, I can do it that way. But if they are hesitant and think that their credit score might be and they want me to do all these suggestions, I have to do a hard pull anyways. So I always send them this link. It comes sometimes a little bit better, instead of me just saying it. I send them this link to the Consumer Finance Protection Bureau, and it talks about mortgage shopping, and, you can't see that. Okay. Well, I don't know why you can't see that, but anyways, it talks about within a 45-day window, multiple credit checks from mortgage lenders are reported on your credit report as one single inquiry. Okay, so for years and years, I've always done this, and I'm like, if people come from different lenders and for a different program or whatever the reason might be, and they're like, but I don't want my credit report pulled again. So we go through this whole thing, send them the link, they finally do it. And I always ask, what was your credit score before? It is always the same, unless they've made a late payment or done something, something else. So it is not treated as an auto loan or credit cards. Really does not affect their score from us pulling this yesterday.
So you're saying within a 45-minute or 45 days, no matter how many times you pull that credit, it only shows up as one?
Yes.
Okay.
So we'll see it on the inquiry. So if I have another, if I have a person that came to me and they've been with, inquiring with several different lenders, I'll see it on the inquiries, but as far as calculating the score, they only look at it as one inquiry.
Okay, so, and that's a standard statement by almost every, a lot of lenders, basically. So my question on that is that even the lenders that have said that previously, you know, when they want a second look at the client or, you know, from a different lender, you know, he straight up even said, well, they're gonna just go to shop themselves with so many lenders that their credit's gonna go down. My clients are seeing it multiple times. They're not seeing one pool. So this is a very difficult thing to say to our clients because that's not the way it's shown.
Well, but there's a lot of factors that go into that. Did they change balances? Did they have, was there anything different on that report? Because that would affect it, and that's hard to say unless you truly viewed the whole first report.
No, they're saying they see, you know, Christina Ocharzak, Homespire Mortgage.
The lender?
Yeah, they're
Oh yeah,
seeing-
I see it. Yeah, I see it. But
So
as
how
far
does
as
it one if my client sees three?
But as far as the calculation goes, it will always show an inquiry anytime somebody pulls your credit report, but it's not affecting it. Like if I see a bunch of car inquiries, it's affected that score. But you will see the inquiry, but they are not calculating it into that score because it clearly shows like mortgage inquiry or whatever. And they're not calculating it into there as being a inquiry. Like it's just one inquiry.
Okay, so to say to our client, because to limit confusion, you're gonna see three inquiries, you're not gonna see one inquiry, you're gonna see three inquiries, but it's only gonna deem your credit once. Is that my understanding?
Yes.
Okay.
Yep.
And then for us to tell them, keep track of your score, because this is where I heard it, and if it goes down again, then we know, because even the lender themselves have said that, have said, well, they're just gonna show them to so many people that it's gonna impact their score and they're not gonna be able to buy anyway.
Yeah, I mean, I'd love to tell people that and not get them to shop me, but that's just not the way it is. Like, they do not want to penalize the consumer for getting a better program, a better price. That's not their goal. You know, that they want people to buy houses. So they're not looking to penalize their credit score. And I can tell you for years and years and years I've done this, and like, the score is hardly ever different. And if it was, they're like, you know, we go back and like look through and they'll send me like the old report of their trade lines or something. I'm like, well, yeah, it's different because now your balance, you just ran it up to $1,000, you know, like, and they're like, oh, okay. So, but they really don't penalize people for that. So, like I said, we can do a soft pull if somebody's totally uncomfortable, but if they want the credit suggestions, like I need to do a hard pull to be able to set them on a path to figure out, is this gonna be, can I do this in 5 days, or this is gonna be 6 months, is this gonna be a year, and what do they actually need to start with? Because a lot of people, unfortunately, they don't know what road to go down. And they think, I'll just pay things off. Well, sometimes paying things off, like it'll hurt you. So we need to strategically play the computer system game and figure out what we're gonna do and how much score increase that's gonna get us on every single bureau to get you the highest credit score.
Yeah, you have amazing programs for clients. But that was, credit score was the one thing that was like, man, I get beat up every time I say it because then they're like, no, that's not your.
And that's why it's
tell them.
article.
Yeah.
That's right, because it's right, like they hear it from us or they hear it from you and they're like, okay, yeah, all right, maybe I believe that, maybe I don't. I've heard other things. And then so I send this. I mean, it's from the Consumer Finance Protection Bureau. Like, you can't get any like more, you know, correct than that.
And it doesn't matter if they pull from you or 3 other lenders in that 45 days, it's
Yes.
still the same. Okay.
Yep.
That way they don't beat us with the realtors up.
Yeah.
Yeah. But that's a huge pushback I get from people. And you know, ultimately, I'm like, if you want me to best help you, like this is how we have to do it. And then I can put them. I even have people right now, like I'll do a hard pull, and you know, they might be like in the best. You know, they might be able to get pre-approved and be fine. But I'm like, man, you could do this one little thing. We'll rescore you. I'll foot the bill. I'll pay for it to get you to get a better credit score. You know what I mean? Like, and then essentially that gets them a better rate. You know what I mean? That client could not be any happier with you at the end of the day. Just by, you know, sometimes it might be $100 they need to pay something down, you know? That's, you know, we try to get people the best pricing we can. And that's a really good way to do it. Any other questions on that? Okay. Okay. I don't know why this thing isn't going. There we go. All right, so on the credit report, what am I looking for? One, the expiration date. Credit report's good for 4 months. All right, so as long as we close the loan in 120 days, you know, we're good. If we do not, then we need to repool. Or if I know that they're getting down to like their last 30 days and you guys are going out writing an offer, and I know that it's not gonna take us through that, I want to pull that credit report now, before you get under contract, before I write that, you know, new pre-approval letter to submit with your offer, because people do all kinds of things, and just because they were pre-approved at the beginning, if I know their credit report's gonna expire, I wanna pull it now. I'm not gonna wait till we get under contract and then, you know, hope that they didn't do anything different. Looking for collections, judgments, bankruptcies, asking about inquiries, all right? If there's something on there that hasn't been reported yet, if they have sufficient trade lines, there's certain programs that require a specific number of trade lines. USDA used to be really funny about it, like you would have, they had to be at least 2, and they couldn't be less than 12 months old. So that's changed a little bit and lightened up, but the other thing is authorized user accounts. We look at those, because a lot of underwriters, if they just have like one authorized user account, that could be a problem. No lates in 30 days. Student loans, that's a huge one. Every product has different rules on student loans, how we have to count those in deferment. USDA, FHA, and Freddie or Fannie is 0.5%. VA has their own calculation. Freddie is 1%. So those are, or I'm sorry, Fannie is 1%. Freddie is 0.5%. So like there's a lot of lenders that don't even run Loan Prospector, they don't have access to it, or a lot of banks, and we're able to take that client, and instead of maybe they qualify FHA, but they could really go conventional, but I can't get them in there on the Fannie side, I can throw them into Freddie and do 0.5% instead of using the whole percent on those student loans. Disputed accounts. This one gets missed a lot by a lot of people. So, for instance, like FHA, if charge-off accounts, we don't have to count. If they're charged off, we don't care. It's done. Unless there's a little word on there that says disputed. So then, if it's a disputed account, if it's over $1,000, we have to manually downgrade the loan. Now it's a manual underwrite. Things just got a lot tighter. A lot of times it just doesn't work. So ratios are tighter, credits, everything. So, and we need a lot more documentation, and they're very hard to get through. So it's very important to read these credit reports like very thoroughly, where if I just have a non-derogatory disputed account, if it's over $2,000, I can use a 5% balance, and just count that and move on as long as they qualify. So that one's pretty important to look at and read your guidelines based on whatever program you're doing. Documents. Again, in that initial conversation, I'm really going through like what documents I'm gonna need from them. You know, if I don't need tax returns, like I'm not gonna ask for them. You know, I'm not trying to make them do more work than what they need to do. Always need pay stubs, right? So if we need 30 days, if they're salary, I love them. It's the best. Hourly. Oh, I could go on days about hourly employment. So if they're 40, it's really straightforward, but we have to make sure that that year-to-date matches that, you know, and they haven't had days off. Like if I get 3 pay stubs that are 40 hours a week, okay, that's great, but you still have to check that year-to-date and make sure that they didn't have a leave of absence or something that supports that. Where we run into the problem is that the client calls and says, oh yeah, I'm 40 hours a week. Okay, great. And then you get a pay stub and it's 39.8 and 36.4 and it's all these different numbers besides 40. Then we have varying income. And then we have to follow agency guidelines, figure out what we can do, what we can use, and go from there. And it can be, sometimes we need to get verifications of employment up front from the employer to see what they're gonna verify, to see what we truly can use. Because the last thing you wanna do is just make a guess at it and get it to underwriting and they're like, not happening. So if they've been there 2 years, it's normally not bad. We go back, we do an average off base, any overtime commission, anything like that. But if they've been there under that, then there's a bunch of rules that apply depending on the program you're doing. Debt to income ratio, every program obviously has a limit. USDA is really funny about the front end housing ratio, and I'm seeing a lot of people that aren't qualifying for USDA just because their income to their housing payment is not, it's not that their debt to income ratio is so bad, it's their front end ratio, their housing expense ratio is too high. And USDA kind of like, I really start seeing non-approvals over 29% front end housing ratio. That's not including their debt to income, their credit cards, auto loans, all that stuff. But a lot of people, the USDA is just way tighter because remember they don't have skin in the game, and they just, that's where we're seeing a lot of people flip to FHA. Okay.
I have a quick question.
Yeah.
So I have a client who just started a new teaching position this year, like in the past month or so. And it'll be salary and she'd be paid more. So she's looking to maybe look at a higher price home because she can afford it or be better for her, you know, monthly, whatever. How soon does that show up that she could use the new numbers, buyer?
She's salary?
Yes.
And she currently works there?
Yeah, she just started a salary position as in a teaching position like a month ago.
Oh.
So we've been looking and it's all, it'll show immediately done. You
Golden.
can go by that, you don't have to go by previous.
Nope. Salary. Love that.
Okay.
So we can actually do, like, I've done a bunch of these, like, especially for teachers, which are great, like even people like moving into the area, with an offer letter on salary, super straightforward. Like as long as there's different rules depending on the program and stuff, but we can do, like we can even close the loan before they start. As long as a lot of their, most of their, it's a non-contingent letter, meaning that they've done the background checks and all of that stuff. But yeah, salary is great. We get a verification from the employer of what their pay is, even if they don't have pay stubs yet. Typically the investor will want a pay stub before what we have to do on our backside is we have to keep the lock through whatever date of the first pay stub is, even if it's after closing. So it's a little more costly if we don't have a pay stub before closing. Sometimes if it's not too much, I'll just eat it and do it. But it's salaries easy peasy.
Okay, good.
All right, bank statements. I hate bank statements. They are, you know, people can make so many transactions in 2 months and you're just sitting there glassing over everything that they're buying, gas, groceries, alcohol. And, but it's really important that we look at every single transaction on these. So if the first thing I'm looking for is what names on the accounts, all right? If there's multiple names, who are those people? Do we have full access to these funds? That's the first thing. Do they have enough money to close? That's really important. Non-sufficient funds. All right, it's really important that we get all pages of the bank statements, and people will fight us on this. They're like, well, there's nothing on that page. Well, that's great, but the underwriter's gonna need it. And so if there's 104, a lot of times those non-sufficient funds will be on page 4, where it gives you a little total. And so non-sufficient funds, I had one guy one time, he didn't even look at his bank statement, and he had like $3,600 for the year in non-sufficient funds, and I had no idea. And I'm like, what are you doing? So that one is very important because underwriters hate non-sufficient funds. Especially with like first-time home buyers that don't have a housing payment, they're living with mom and dad, and you're like, okay, well now we're gonna take on a housing payment, but we can't manage what we have. A lot of the underwriters will make them to a budget. So that gets fun. So we want to address that up front so it's not a problem down the road. Deposits, another big thing. You know, if we're doing USDA or anything like that, we got to know, like, are they doing a side business? What's that deposit from? Can we use these funds? Where did it come from? If they're selling something, if they just sold a car, you know, do we have a bill of sale? A lot of programs will make us do not only a bill of sale, but proof of ownership that they owned it. So if we're going to use those funds, we got to know where they came from. And then reoccurring debts. A lot of, right now, there's so many like buy now, pay later things. Affirm, I don't know, somebody just sent me like 3 other ones that were out right now. We have to count those. So, you know, if they have like an extra $100 a month in those, like we have to count those payments. So it's very important that we check every single debit that's coming out of there and we know what they're for. Down payment options, gifts from family member savings, down payment assistance programs, Chinoa, stuff like that. We need to know where their money's coming from, if they have a down payment, is it viable? FHA is very funny about gifts. They do require the donor provide a bank statement showing their bank statement, showing that they had the money in their account. People do not like doing that. A lot of people do not like doing that. So I'm very adamant, if they are getting a gift on an FHA loan, I want to talk to that person giving the gift and make sure that they understand that they have to provide me a full bank statement, no redactions, nothing, like I need the full statement, and that they're comfortable with that. Because I have definitely heard of that killing a lot of people's deals because the parents don't want to provide it. So beware of FHA gifts. All right, so we always talk about the possible, you know, out-of-pocket costs, home inspection, earnest money, appraisal. You know, we do a lot of first-time buyers. A lot of people are just scraping by. And, you know, we talk about we have to have this money in your account for sure before you're going to write an offer. Tax returns, W-2s, depending on the program, depends on how many years I need. They're pretty straightforward. All I'm looking for on those is to make sure they don't have any business expenses, if they're Schedule C or anything like that, and that their income isn't declining. A lot of people, one of the hardest things for me on tax returns and W-2s is people don't know where they are. They have no idea. Like, they went into like fairy tale land, you know, they did them online and they're like, well, I don't know how to get them. So that's probably the hardest thing on there for me. I tell them, you know, try to either find, if you use a tax preparer, they can give you a copy. If not, they can go on the IRS website, get transcripts for the tax returns and W-2s. Documents continued. You know, again, this is why I do that initial consult, because I could send them a laundry list of documents that they might need. So 401ks, I love getting retirement statements. Underwriters love reserves. Okay, they absolutely love showing that we have a little bit extra money if ever needed. If there's separation or divorce, we need that decree, make sure we don't have any alimony, child support. I have definitely been told before that they don't pay alimony and child support, and they don't want to give me their documents, and then I get it, and they don't pay it, but they owe it. So that is definitely a necessity. Child support agreements are really important if we're trying to count that income. All right, there has to be a 3-year continuance on most programs. So if the child is under 15 years old, we can use it in certain circumstances depending on how long they've been repaying that. Bankruptcy papers, we're looking through those, making sure there's not a house included in the bankruptcy. If there is, then we need the foreclosure documents and see what the timing is on the discharges and all of that. For veterans, we get a certificate of eligibility. We pull that. A lot of times we can do it just automatically now with the VA. If not, if they're like a very old service member, sometimes we do have to get a copy of their DD-214 to be able to pull their certificate for them. Social Security awards letter if we're using Social Security income. And then we just talked about foreclosures, driver's license. And then if we're doing like USDA, all right, on USDA I need to look and make sure we have an automated approval. Make sure the asset test is okay, all right? They cannot have 20% after closing in liquidated assets to qualify, and make sure their eligibility income is okay, that they're not over the cap based on the household size and location. Then all others residing in the home, we need, if they have income, we need their date of birth, 2 years W-2s, a month pay stubs, name, address, and phone number of employment. If they do not have income and they're over the age of 18, we need a notarized letter stating that they do not have income and are not seeking employment. That one's pretty important. So, Lots of different programs. We do USDA, FHA. We have an FHA manufactured program. We do the FHA Genoa program for 100% financing. VA conventional, and we have 2 rehab programs, one being FHA 203K and one being the Fannie Mae conventional homestyle option.
So you
So-
do the West Virginia Housing Development Fund?
So I did, and I like Genoa tenfold over. It's the same thing, no income caps, no, they don't have to be a first-time home buyer. It is literally the exact same program. Still borrow the 3.5%, 10-year repayment schedule, same thing. I just don't have to go through the stuff, and it's a very attractive offer because I'm a 30-day close. I look like I am an FHA loan, like.
So the Genoa funds don't run out?
Nope. I think we've had one time that it did, but not for a long time. Yeah. So they've been fully funded for a good while. I love those for here in West Virginia. So all those programs are going to go through one of these systems. All right, and this is so important. For FHA, you can run either DU or LP. All right. Sometimes they just, DU won't like it. So I'm like, all right, we'll run it through LP. Sometimes it just likes it and it'll take it. Conventional, you can run either DU, LP. Same thing with VA. For, what was I gonna say? Oh, USDA. It's GUS, Guaranteed Underwriting Systems. That's what we use to run all of these programs through. It basically looks at the whole file. It's looking at everything, the credit profile, how many trade lines they have, what kind of makeup everything is, what their ratios are, how many reserves they have. Sometimes on a USDA file, I pop 2 months reserves in and it gives me an accept. If I don't have any reserves, I'm dead in the water. So reserves can be a deal breaker. Especially on USDA. And FHA, I've seen a big difference too on the reserve factors. So estimates, this is a big one I get from, wow, that was a long time ago. Look at the rate. So estimates is a big one I get from a lot of realtors, especially new ones. They're like, well, why are the closing costs? Why are your closing costs so high? Well, closing costs, there's so much that goes into the closing costs. So those top 4 things right there, the processing, appraisal, credit report, and then I always throw an inspection fee on there just in case if we need to re-inspect for the appraisal. Those are the only things I have control over. That's it. Everything else is me estimating what somebody else's fees are gonna be, what the title charges are gonna be, what the recording fees are gonna be, your admin fee, if there's going to be a survey or anything like that. And then the big part is your insurance and your taxes. So we have a very small part. We'll see a lot of lenders crunch these numbers and make them look prettier than the other one. I always tell somebody, like if somebody else is shopping me, or they'll call me and they'll say, hey, I just want to know like what the costs are going to be and whatever. I was like, yeah, I'm happy to do that for you, but you owe me 15 minutes and the other lender's estimate so we can go down through it and you truly you truly understand what you are comparing. Because I could cut the escrows and I can take, a bunch of money off if I don't want to escrow, my property taxes or whatever, and I'll put 2 months versus 8. But if I know that we're going to need 8, that's what's going to be at the end, well now they're too far down the pike, now they just have to do it. I want my estimates to come out lower. I prepare for the worst and we get better, not the other way around. Because nobody's happy at the end of the day with that. So I'm happy for anybody to ever shop me, but I tell them, I want you to truly understand what you're doing instead of just looking at rate or just looking at these fees, because you can make them look any way you want to.
On this particular estimate here, where is the lender's fees at? Is it just not on the slide?
So the lender, right there, the ones highlighted in yellow. I didn't put them in, I just basically popped these out. This is from like years ago, obviously, from 2.675 on the rate. But our processing fee is $11.95. That's what we are. In West Virginia, you can't charge an application fee, so we do a processing fee. There's no underwriting fee. So we're $11.95 on processing fee. appraisal fee depends on what kind of loan they're doing, anywhere from $575 to $625. Credit report fee, I think for individual it's like $64 and $90 for a co-applicant. And then I do $175 inspection fee. If there's, I just throw that on there in case the appraiser needs to go back for some reason.
$11.95 not a bad fee.
No.
No, it's not bad.
But, let's see. So, interest rates. This is a big topic right now, obviously. We all know that. So for some of your like housing programs, it's the same for everyone. So like the Pennsylvania, West Virginia, Maryland mortgage program, all of them, it doesn't matter. They're not giving you any credit, like anything like that for credit scores. On your regular, just straight FHA, USDA, VA, conventional, they're priced off a lot of factors. Lock-in time period, terms, loan to value, all of those things play a part in that. So, your credit score, your LTV, is it a purchase, refi, cash out? I had a lady call me the other day and she's like, how are you gonna cash out? I was like, no, you don't. Her rate was like, I don't know, 3% or something. I'm like, no, go get a home equity line or something for now. You do not want to refi your whole mortgage on cash out. Cash out pricing is not attractive at all right now. The economy, obviously. Is it a primary residence, second home, or investment property? Right now, investment properties are incredibly high. You're going to pay points. They're just not something that investors want right now. The loan amounts, and then are you paying points? Which we're really going to get into in a second right now. Okay, so how many of you truly understand how points work? Okay. So this is a pricing grid, okay? So when we pull pricing, and again, all of these things are going to come into play. It's going to be different on every single file, every single individual, and every single program. We generally get 15, 30-day, 45, 60-day locks. I mean, we have extended lock programs, all kinds of things, but this is just basic grid for you. So you'll see that a 7 1/4 on a 30-day lock is 3/8 of cost, okay? So back in the day, lenders actually used to get paid on overages or underages. A lot of times we would have negative numbers. So that means that the company, if I could lock them in, say my pricing grid went higher and it's 7.5, I was getting 0.5% back. Lenders would get paid to charge the consumer more and I would get an override on that. That is no longer the case. We do not get paid like that. So we obviously have a huge incentive. We want the client to have lowest rate possible. They figured out that was not a good idea because people were getting charged for a lot more. So this is kind of what it looks like, all right? So one of my biggest, I am not salesy. I hate sales actually. But when I get a client that is, on the fence, back and forth, my go-to thing is points, all right? Just having the conversation. People are so rate driven that they're like, but this one is an 1/8 lower. Okay, great, but let's look at all your fees, let's look at the costs, and does that 1/8 really matter, or can we get you better than that? So points. So on that same pricing grid, all right, if I take 7.325 for the zero cost, my payment is $23.21 a month. If I go to the 7 1/4 with 3/8, it's going to cost $1,200. $1,266. That's only $17 a month different. So what I do is I figure all this out for them. We go over it. This is based on a $377,000 house. So when you get into lower price ranges, the points are not nearly as much as on these higher ones. But if you look at the breakdown, okay, so now my payment went to $2304. If you take the cost, an upfront cost, divided by the savings, in 6.2 years, they're gonna start saving $17 a month. Okay? So that's we really get into the conversation. How long are you gonna be there? Does this make sense? Watch this. So if you keep going down, you'll see break-even periods, 4.5. This is what I really focus on. 4.2, 4.4, 2.1. This one down here is, it goes from 1 6/8 to 1 point down here. So that doesn't make any sense, right? The only way I can explain that without having a secondary marketing analyst in here, there's certain loans that are more attractive and they want to incentivize people to take these certain rates because they're gonna make more money on the back end of that.
They want their money cheaper from
Exactly.
secondary housing.
Yep. So that is going to save them $130 a month, and it's going to cost them $33.77. And in 2.1 years, then they truly start saving $130 a month. All right. But for that person that's shopping me, you know, for that top rate, the $17 a month, like, do we really, you know, care about that? Like, maybe I can do something else, cut a little cost somewhere else for them, do something like that. Or maybe we have this whole conversation and I'm like, man, nobody ever took the time to go through this, and I would love to have the, you know, the 6 3/4. That'd be great. And so many people right now, they're saying, you know, marry the house, date the rate, you know, all this, whatever, that's great. I can't promise you rates are gonna go down. I would love for rates to go down. But does anybody really know if that's gonna happen? I mean, and then to what extent, right? Because then it's gonna cost you refinance fees all over again. So, you know, it's important to educate the consumer. That's what we're here to do. Then they can make their own decisions. If they say, hey, I'm only gonna live here for a year, well then I'm not even gonna look at any of this. Why would you pay points? You know what I mean? So it's very important to customize it to your borrower. Any questions about that?
No, but that was the best explanation I've ever heard on points. Because that was a great area for me, and you just made that clear as daylight. Like, that is the best explanation I've ever heard on that.
Thank you. The points are very confusing, and people don't, you know, they don't understand it, and we get the calls all the time, well, what's your rate? Well, it's whatever you want to pay for. You know, like, because, it's insane, and most people, and that's why I tell them, I want to go over your estimate. Most lenders are quoting a point off the top.
Yeah.
You get the estimate, and it's got a point included in that. And the borrower doesn't even know it. They're like, oh, okay, well, I see 6.75. And I'm like, okay, great. Well, you're paying $3,000 to get that.
Right.
But you don't even know what you're looking at. And that's why it's important to go through it. They can have whatever rate they want. I mean, I can go way on down, and they can.
So does each point break down to like a 1/4% on the rate?
So each full point is 1%.
1 whole percent?
Yes. So this here, like if you take this, you would take the 377,750 times that right there, and that's going to be the cost at how much that's going to cost you right there. Yep. So you'll see like your 1 point right here is 1% of that.
Okay, gotcha.
Okay, so now we got them pre-approved. We've gone all over that. I typically don't have the rate conversation. If they're shopping, you know, obviously, if they're under contract, we're having that conversation. You know, I typically don't really get into rates until after we have a house, because why? Like, they'll be different by the time they buy. Like, I promise they'll be different, especially in this market. So, you know, I give them a general overview, and then, you know, it'll be in this ballpark, you know, but we're gonna have that detailed conversation when we're actually ready to lock. We know how many days we need to lock the loan for, because that matters. And we go from there. So now it's time to shop. We let you all know, you know, what program they're gonna do, the price range, and if the borrower needs seller concessions or if they're coming up with their own. Run payments, estimates as the borrower shops, and then when we have a ratified contract, we're on to the loan application. So, general information, just little tips. I've said this once, we don't make more money by charging higher rates as loan officers. Set realistic goals for closings, we all know that. Watch the financing contingency date. I see all kinds of things to be put in for that. Make sure we have enough time so people can't get out of these contracts. That one doesn't apply. And then, you know, just realize everyone's on the same team. The best deals I've had is when realtors are calling me. They're not just taking letters and like submitting them and I don't know anything about it. They're calling me going like, hey, you know, I think maybe if we showed them numbers at this, we could do that. And, we're working together as a team and trying to put this together. Check with your lender on seller help for a number, not just a percentage. I had a broker once call me and say, well, what is this? And I'm like, well, they need, I don't know what it was. It was like $57.50 or something in closing costs, like way back. And she said, well, that's not a percentage. I'm like, well, sure, it's a percentage. It might not be an even percentage, but like, why are you putting percentages in? If we don't need that money, why are you doing that? Use a number. Use a number.
If you gave me 3 guesses, I bet I know who the broker is.
I'm like, I don't understand. If you need 6%, by all means, put 6% in. But if we don't need 6%, put in the actual figure that we need. Otherwise, you're leaving money on the table, and your offer is just, you're losing out. So make sure you get with your lender, get an actual figure of what is going to be needed for this. All right. So once we have the contract, I'm locking the rate. I'm having that conversation on points. Does it make sense? Is this something you want to do? And then we're sending out the disclosure package. Most clients right now, when I started, everybody came in. They wanted to sit down, they went over it, they actually fully understood it. Now they don't want to give us the time of day. They just want me to send it off. So I'm very adamant, like when I get them pre-approved, we go over the whole estimate so that they know. So when I'm sending these estimates, they understand it. I want them to go through one, at least with me fully, instead of them trying to determine what to make of it. So we send the paperwork out, and then we look up for anything, like if I know things need updated, that my processor's gonna need, I'll go ahead and ask for it. Or if they need to take a home buyer counseling class or something like that. So then I send it to the processor, who's gonna order the appraisal, the verifications, the title work, and kind of get everything prepared for underwriting. But by this point, we've done a pretty good initial underwrite if we're doing our job correctly. So when it gets to underwriting, all right, they're looking at all the same things that we looked at. They're just making sure that it meets all these investor guidelines specifically, and then they're looking for who to who would be eligible investors to put with this loan and where it might fit. Like for instance, if we're doing a conventional loan, it might not fit PennyMac guidelines, but maybe it fits, Chase or Bank of America, and their job is to look for the investors that that this file itself fits to where we could to send it, if need be. Right now, we're retaining most of our loans. Servicing has in this market been a very good thing for lenders that are servicing. But a lot of are still selling off. But right now we are retaining most of ours. So they're looking at assets, making sure, the gift funds are acceptable, seeing if we need any other documentation, looking at the employment verifications that we've gotten in, reviewing the appraisal, looking at their credits, and then they're rerunning those automated findings to make sure that everything is still good with that. So then we typically get conditional approval. All right. Sometimes we just get credit conditional approval. Sometimes we still need the title work. We still need the taxes verified. We still need an appraisal, or they need their homeowner's insurance policy yet. If they're going through a state agency, we have to have conditional approval before we can send it off to that state agency for their approval. In the case of like Chenoa, we underwrite those in-house. So we have the delegation to go ahead and approve those without sending them to Chenoa as an investor themselves. And then we are finally approved. Once we get all those conditions, we send it back and we're good to go. Then we send the CD and we go to settlement. And then after settlement. So loan servicing, again, they're going to determine where this loan goes. Is it going to stay in-house? Is it going to get sold? Like for instance, we do the Maryland Mortgage Program in Maryland. Those all go to US Bank. There is no option to keep those loans. They're all serviced by US Bank. So that loan's going to go to them. And then they're going to get their letter stating where they're going to make their first payment. And they're going to get a ton of junk mail. So I talked to them about that, all the things they're going to get. Don't pay for your deed, all of those things. All right, so common challenges, the most common challenges we see is people applying for new debts. Anytime they apply for anything, we get pinged. And then I go back and ask them, what the heck is that? I told you not to do that. Income changes, it happens all the time. I'm like, who buys a house and changes their job at the same time? Why? But it's a lot. It's a lot. And sometimes I've had people take positions and it knocks them out of USDA. Now they're making too much money. So sometimes it doesn't, it's a good thing, but even though that they're making more money, it could knock them out of that program. Gifts, like we talked about. Gifts is another one. Can definitely be hurdles and stuff, so I try to get my ducks in a row on gifts. And that's it. Questions? You guys anybody up for hire, be a mortgage lender now.
You did so good. I love lunch and learn. As a matter of fact, the last lunch and learn you did, you provide us with spreadsheets for a CRM.
Yeah.
Do you know, Christina, that I still use that spreadsheet?
I love it.
That is and that's how I keep track of client gifts and things like that. I absolutely love attending your lunch and learns. I think you do a fantastic job and you answer every question.
Thank you. I'm glad you used that.
I don't think that's a question,
That
but
makes me happy. Well, thanks for the
and Jennifer will tell you, I'll say exactly what I think.
I know, that's why we all like you. Anybody have any questions? Yeah.
So you mentioned, the bank statements that you go over every single thing that they buy. What if they do ATM cash withdrawals? Is that frowned upon?
No, not the withdrawals. I just don't have enough money. I don't care what they're taking out. But yeah, we just really look at the deposits more than anything to make sure we can either use those or make sure that it's not additional income that we need to address in some way.
Okay,
Now, the only thing that I would question on that is if I saw that they were doing a same month time amount withdrawal of that ATM, I would question what it's for because the underwriter may say, is that debt? So, but if they're just taking out $100 here or whatever, we don't really question it. But if it's a large amount and it's consistent, then yeah, then I'm gonna ask, make sure it's not debt.
Say go cash up thing about weed dealers. Anything that's illegal. Oh, don't think it has to happen. It's happening.
But I tell everybody, if you get anything, it would make your life so much easier, and I have that conversation when I get people pre-approved, just don't deposit things. If you get a Christmas gift or a check or whatever, just, take it to the bank and get cash, don't deposit it, and that won't bug you, and our lives will both be great, so.
No, what about, a lot of people are using Cash App, so say they transfer from their spouses or whatever, Cash App.
Yeah, I mean, it's okay unless we see, again, a consistent, something that could be a liability. But yeah, that's a lot, and that's what I'm saying. I hate bank statements because people are Venmoing and Zelling for drinks and this and that, and you're like, oh my gosh, stop going out. But yeah.
I feel like the banks have done that to themselves. I'm going to tell you why. Because back a long time ago, maybe before you were born, we used to do bank verifications
Yeah.
and employment verifications. But then, people are like, well, it's just easy. It would take too long. They didn't want to pay the $10 that Wells Fargo was this or that. They didn't want to go. The client would have to go. Then it proceeded on to where they went online and paid for it, blah, blah. And clients didn't want to go there. So, okay, just give me your bank statement. So you kind of brought it on yourselves. Just
Yeah. Now, that being said, we can do a verification of assets. So if I really get in a pinch on somebody that has a lot of things that I don't want to deal with, I might be getting a verification. But a lot of these banks now are taking forever to give them to us, and it costs a good bit of money. But on people that have these non-sufficient funds and stuff like that, sometimes it's easier to get a verification and do that. Or if I'm trying to catch pay stubs and there's not a bank statement available, I might do a verification once I know they say, hey, my paycheck's going in on Friday. I'm like, okay, great. I'm gonna contact your bank and Monday we'll have this. So. Yeah, there's lots of options. The mortgage industry has changed a lot. I know my mom, she's been in for 30 some years, and she's like, it used to be so simple, if they had a credit score, give them a loan, you know, and now,
Credit scores.
and now she's like, it's if this, then that, you know, and that's why, unfortunately, you know, the online lending thing has just become a little bit of a train wreck because not only is there's just so much to review if you're truly doing it right.
It's good to know about those set amounts, because I actually take a set amount out of my bank via ATM, like I pay myself once a week, and it's literally always the exact same amount.
Yeah.
Until I feel I deserve a raise, but that's my kind of
But
keep
that's
me on
okay.
track.
And so in your case, being that you're self-employed, like we would get a letter stating like, this is what it's for. So you would just do a letter of explanation and it would be okay. So again, as long as there's a reasonable explanation, then we can a lot of times make a case for it. So, anybody else have anything?
No, just making sure too, like one thing that comes up with the client side, I don't know if this helps lenders at all, but something that'll come up on the client side for me a lot is they won't have bank statements. I know they must be like hell on wheels for y'all, because that's always like they want my bank statement again. When I've called a lender before, and I'm nice now, okay? But I said, why is this consistent? They replied, oh well, they sent exactly like you described, 12 pages 1 through 11. And I'm like, okay, so make sure that I understand you correctly, that your processor has called my client and said, hey, thank you so much for sending your bank statement. We received it, however, we're missing it. Like, we're not just automatically sending things out like, I need this again. We do our best to prepare our clients, because I'll tell them, and I love you, Christina. I just love you. But I'll say, listen, you're gonna now, Christina's your new best friend, okay? Anything she asks, she needs it right away. I'm no longer your best friend, she's your best friend. If there's any sort of hiccup between you and Christina, then you call me and I will jump in immediately. They're gonna call me anyway.
Right.
But, you know, you're gonna feel like the underwriter ate all your paperwork, because Christina's gonna ask for something, and you say you're gonna ask for something again. But I did finally follow back up with a lender, and one thing was, I don't know if it was automated or not, but it was just like bank statement for September. And they're like, well, I sent that. But they don't fully understand what they did wrong. They don't understand that they were missing a page. And so it becomes very irritating to my client. If my client gets irritated and buzzes up my phone, I'm gonna be irritated, and then other phones are gonna ring, because I just don't like anyone messing with my babies.
Yeah, no, I get it. So there's lots of options, but again, it's like everybody what they're comfortable with. So we have a thing on our application, like they can go ahead and put in their bank credentials. We do not have access to them. We can't do it. Some people are. And I tell them, if you want to do that and go through that route, I can pull their bank statements for like up to, I think it's 120 days. So I don't have to bug you for this anymore. Like I can just request. But a lot of people aren't comfortable with that. So then I'm like, all right, well that's fine. I get it. But then I'm gonna need you to provide them. But that's why up front, I'm asking for page 1 through 4. Because I don't want to go back later when they think they've done it. You know what I mean? And then now they're like, oh man, well I already did that. But they don't fully understand that now that they need this. So, and I mean, it depends on the processor. Fortunately, we have 2 really great processors, and they know, and they pick up the phone and they call and they, you know, have a good conversation instead of just sometimes slapping an email and they don't understand, or they didn't read it because it's too lengthy. I tell the processor something like, short sentences. I don't read long paragraphs. So, yeah, it's just all how they want to do it. A lot of times they'll need to ask for that updated bank statement to verify the EMD has been paid. So that's a pretty common one, to make sure it's cleared the bank account so that we can give them credit for it. So that's the number 1 reason we're going to ask for bank statements again.
This is why this stuff is so good, because as we learn more about what affects, you know, what lenders might be looking for, we should use this as an opportunity to be proactive and make sure our clients are like, listen, if don't tell me Christina messed up your file if you just send her pages 1, 3, 5, 6, and 7.
Yeah, it's a lot of stuff, and I tell them, you know, this is the least fun part of it, but that's why I try to get so much up front so that, you know, we don't have to go back and chase a million things through the process. So, and, you know, hopefully the loan, you know, 99.9 goes to closing pending, like, the seller dying or something, you know, happening crazy. So, yeah, I mean, yeah, bank statements are definitely a pain, for sure.
What about the tax statements? What about like when they give you their tax returns, do you verify that independently with the IRS? Or?
We do,
Because
yes.
I had a client that they didn't even know, they had like a $14,000 like back tax thing that they didn't know that.
Yep, so when their initial documents go out, they're gonna sign a tax form that allows us to pull their transcripts. So then that's part of the processor's job, is to go ahead and submit that to the IRS and get verification of their taxes, even if they are not, say they're older and they don't need to file. Like we have to get back that there's no record of accounts. So yeah, we've definitely discovered, back taxes, that's never good.
Oh, I just had a client that didn't file taxes for 6 years.
Yeah.
And I said, I'm sorry, what? But oddly enough, believe it or not, they can file them one day. And I said, well, why'd you stop filing taxes? He said, I was doing TurboTax and told me I owed, so I just stopped doing it. So that's an option.
That happens quite commonly.
He was a W-2 employee, folks. Like, I understand, like, self-employed, I want to go to no poke. So I pay my taxes. But we were able to get him a touch account. You can do, like, I didn't realize this, and actually, Lucas had to explain that to me, that you can do, like, 6 years in one day.
Yeah.
Because I was like, oh my God, I'm going to have to call this other realtor. I hate letting my partner down.
Yep.
And they're like, no, I'll get it done one day.
And then we just need, so tax time, it gets fun, because then we have to, the IRS has to not only receive them, but we have to be able to get the transcripts. They have to have been processed. So then tax season's like a nightmare. And there's a bunch of stuff we have to get through for that, but we won't get into that. Anybody else? No? All right. Well, thank you guys very much.
Thank you.
Yes, a big thank you again to Chad, Lynn, and Christina for giving us a good lunch and learn experience today.
Thank you so much.